Okay, so welcome everybody for our session today on raising growth capital beyond Vermont. So we're going to be talking about advanced finance for small businesses. This is hosted by and for the Vermont Small Business Development Center, VtSBDC, in connection with their program, the Small Business Credit Initiative, also called SSBCI. So, who do we have today? We've got three of us from the Vermont Small Business Law Center and Clinic at the Vermont Law and Graduate School. I am Brian Bailey. I'm a staff attorney with the clinic. And I'll pass it to you, Oliver, to say hello.
Hello, I'm Oliver Goodenough. I'm a professor at the Vermont Law and Graduate School, and also at adjunct professor at Dartmouth, where I teach a class on entrepreneurial law for their engineering school. And in addition to being a teacher, I have represented in practice a number of folks in raising capital, and I have also been part of a company which went through several rounds and had a successful exit last summer. So I've seen it from academic representation and being a principal as well.
Great. And Aude Mathilde, do you want to say hello in a few words?
Sure. So I'm Mathilde Gallo. I'm a former student of Vermont Law and Graduate School, and I am now a volunteer at the Small Business Law Clinic.
Great. And as I said, I'm Brian Bailey, working with the clinic. I also have a private practice in which I represent small businesses with all sorts of business needs. So, yep, we've got a lot of experience in the room today. So, what are we going to be talking about? The idea is businesses sometimes need to raise capital so that they can expand or continue doing whatever it is they're trying to do. And sometimes that capital needs to go beyond sort of the friends and family and other local and community sources that we're used to. So we're going to get into the details of how this is done, what this looks like, how businesses can prepare for it. We're going to talk about what are the sources of capital. So, where does one go looking if someone's trying to scale their business and needs capital to do so? What kinds of deals are there that are done in this context, and what sorts of documentation accompany those kinds of deals? What about corporate governance? What do the owners of the business need to be thinking about in terms of structuring the business and governing the business to prepare for this and guide it through this and other things that founders have to concern themselves with if they're looking to raise capital from outside. The SEC, of course, is a major player in this world. That's the Securities and Exchange Commission. So we'll talk about SEC regulations and other considerations in connection with the SEC. And of course, tax can play a major role in this as well. So we'll touch on that. There's plenty of time for questions at the end, the way this is structured, but we have a small enough group today that you're also welcome to bring questions in as we go. You can either put those in the chat and we'll be monitoring that as we go along today, or feel free to unmute and bring your question in real time. It's nice when we have small groups because we get an opportunity to do that. So with that,
Okay.
I'll pass it to Oliver. We're going to start with
Um,
a discussion about sources of capital.
just wanted to cut you for a second if you have the slides, or if you have shared them.
Oh, I'm sorry. Hang on a second. I thought that I had shared them, but I have not. Okay. That's a good thing to point out. All right. Should be able to see them now.
There we go.
Very good.
Well, th thank you, Brian. First topic really on this is sources of funding. The talking about beyond Vermont is really kind of a catch-all for it. Could include some inside Vermont sources, but it really is talking about how to go out into the world and find capital in markets and sources that are not just your immediate network. So the sources there's what's often called FFF, triple F, which is family, friends, and fools. These are the folks who will invest in you no matter what. They are the near and dear. They will invest in you. For the most part, what they can invest isn't that big. Maybe help get it started. That can be a useful source for folks in a smallish business. In a business that's going to require more capital, with ambitions to do millions and multi-million dollars worth of business and development, they are typically not going to get tapped out fairly early, and they maybe provide a little bit of an early stage development war chest, but that's what mostly they can do. Uh, there are in addition to the sort of immediate network, there are some other local sources and investors. Vermont has two or three venture capital sources that I'm aware of. It has folks who will invest with deeper pockets. There are incubator spaces that can help with this. The Hula space in Burlington can be useful in this kind of context. So it's not like one has to go beyond Vermont, but one can tap those out fairly quickly. And again, if it's going to be significant investment, that can get stretched fairly quickly. One can also think about angels and private investors, and these are beyond the FFF. These are folks who are interested in investing. There are people in this world who have made some money or have inherited some money, and they are interested in putting it to work in ways that aren't just leaving it in the stock market. These folks can be active. They can be active investors, sometimes with fairly significant funds. And they are worth, if one has access to those and they're interested, they are terrific typically to go with because they will often have fewer strings attached than some of the more industry and venture capital style investment. That said, if they are difficult people, and sometimes they are difficult people, involving difficult people in your company is also not a great idea either. So again, be selective with that, but understand that there are folks who can do that. Some of them will be Vermont based. They're around the country. My own company, we had folks falling into that category from Nashville. We had folks falling into that category from San Francisco, from New York. Again, there was a bunch of different places we could meet and get their interest. Industry capital. Industry capital is getting money from the industry you're going into. If you have a pharmaceutical product that you're developing, one of the things one of the sources for that could be big pharma. Big pharma might invest. The company I was involved with, we had initially some legal technology, and two or three of the legal tech firms invested in us. As we pivoted more and more to financial technology, a bunch of the financial technology people invested in us. Why are they doing that? Well, partly to get a return, but also because they are making sometimes those things come with strategic alliance opportunities and constraints. We'll talk about those a bit more as well. But that finding somebody in the industry interested in investing in you is a possibility, and in fact, in many ways, a good one. Then there's venture capital. By the way, interrupt with questions as we go. I'm a professor, so I will chat on regardless if given the chance. Venture capital. Classic source for this. It exists in a sense to provide capital in these kinds of circumstances, but its target tends to be somewhat limited, and limited in the sense that most venture capital funds raise money on a 5 to 10 year horizon, and their fund that they are deploying, the folks behind it are looking for significant returns. The VC folks are looking for significant returns. They tend to look at things that they think can scale significantly. Obviously it's hit or miss, but because they only get a few hits, they want those hits to be something that will go big. They are not interested typically in a chain of Vermont general stores. That might be a perfectly good profitable business and be shown to be, hey, if we set up a chain of these and run it well, we can make a nice amount of money. They're not interested in that typically. Why? Because it's not going to scale. It's going to be a nice chunk of money, but it's never going to be $1 billion company. So again, they're looking for things that will have 10 times plus return, so their targets tend to be in things like tech and things like medicine and health in areas where a breakthrough company really can have that kind of effect. Online portals, online portals. There are online portals for raising funds. The SEC has to somewhat reluctantly licensed some of those. They are worth understanding and knowing about. They are a little hit or miss as well, from my understanding. I've not had direct experience with them. Folks have made them work. Again, we'll talk about those a bit more later on, how they might work. Private equity. Private equity is a term that's sometimes applied to sort of institutional looking, or even if it's going to be just a family office or whatever, but a kind of an established investment fund that is not a venture fund, that is intended instead to be really, money looking for smart investments. In some ways, it's like the angels and private investors I spoke of before, but it's a more institutionalized version of that. They are looking around for opportunities. Sometimes they are very industry specific in their focus. Sometimes they're just, saying, hey, if we put $1 million in this company, can we get 3 or 4 back? They are often a little less voracious than the venture capital folks who want 10 times back. These folks may say, hey, if it's a good deal and we get 3 or 4 times back, that would be fine. So they line up a little differently in their interests than the venture capitalists might. Okay. Questions so far on those sources? Again, there are others out there, but this covers a lot of what we see in the marketplace. Non-diluting. All of these so far are diluting. We'll talk about that in a little bit. Diluting essentially means these folks will want equity. They will want a slice of the company. And as a founder, where does that slice come from? It comes from you. You are going to give a slice of the company away for some money. That's part of the deal. There are non-diluting opportunities, which are often grants of some kind. The Small Business Administration sometimes has grants. There are other grants that I'm aware of for instance, in the med tech area sometimes, or pharma area. There are grants available to help develop products of various kinds. Government sometimes makes these grants. There's a process in getting them, but they can offer decent money. The Defense Department has an investing wing, and those investments are almost entirely in the form of grants over time. They are terrific on one level in that they mean that there is not a dilution. The founders aren't giving up anything, but they are also limiting in another direction, because that they often require a lot of paperwork and very sort of project specific. Do we meet those criteria? And if you don't, you don't qualify. Last thing I'll mention is loans. Loans are sometimes available. The loans come from a variety of different sources. Different deal. We're going to be focused here mainly on equity deals, but loans are sometimes out there. Early stage companies are not always attractive from a lending standpoint, because things are speculative, and the upside is there, but also the downside. And lenders like to know that they're going to get their money back for their loans. We'll see that there's some convertible loan options on this, but the key point here is that in the right context, there may be loans. Sometimes a venture fund will, excuse me, will advance a loan in conjunction with other investments. There are sometimes mixes that one sees. They are tricky, and again, as I say, we're going to be looking mainly at equity in today's session. Questions before we go to the next slide about sources?
And I'll just interject here to we've had a few folks come in. Feel free to ask questions. You can unmute and ask your question directly if you like, or you can put a question in the chat, which we're keeping an eye on, and we can address those as we go.
Exactly.
We'll also have Q&A at the end, but feel free to interject. We've got a small enough group. It's totally fine.
Before we move on, Kat, would you have any contribution on this, on what you guys see at the SBDC on capital sources?
Yeah, absolutely. So, work closely with the SBA for some of those loans. We actually, oh, can you hear me?
Yeah.
I didn't have my little toggle down. Yeah, and so, the 504 loans, the family, friends, and fools, I know is always kind of a nice starting point. I do see that it tends to get a little bit a little murky, and so again, good starting point. But working with economic development or RDCs, being able to kind of hone in on what loans work best for what you're looking for. especially with some farmers, equipment loans we see a lot. And, being able to just navigate what you're looking for and finding the right fit. Our advisors are really helpful in kind of doing the checklist on what you might have exhausted so far. So going to your local banks, credit unions, and then of course, the SBA, some of those loans are after you've exhausted other avenues prior to reaching out to them.
Great, thank you.
Yeah.
Any questions before we move forward? Brian, any additions you would make on this from your perspective?
No, I think it's we're going to talk more about the moving parts here. These kinds of deals are quite different when the rubber meets the road and the pen meets the paper, right? So we're the way the agreements are structured and the pitfalls and the things that business really need to consider. That's the key thing, and that's what comes next.
Okay, excellent. Next slide. So what are the deals that are out there? What are the deals that are out there for this? Again, if we're looking at equity, essentially what we're seeing is people getting a slice of the company. And as we're going to talk a little bit further later, the companies in this context are generally, but not exclusively, corporations. The LLC is a wonderfully flexible form, often used in sort of more local fundraising circumstances. Bring in members as investors; they can come in and be participants in that kind of way. Works well for a group of 4 or 5 investors who are coming in on a local kind of basis, or an industry investment if folks are coming in that way. If one is going out into the world of more generalized capital raising, it is still anticipated that the vehicle for the company will be a corporation. And it is also anticipated that that vehicle will probably be a Delaware corporation. You occasionally see California or even Nevada, but the classic expectation is a Delaware corporation. Vermont corporate law is perfectly good. It works very well. Again, if one wanted to be a more local corporation, Vermont is terrific. If you're trying to raise money out in the world, that people are just going to say, well, why aren't you a Delaware? Because that's what our paperwork all looks like, and that's what we want. So again, it's going to be typically in that context. One possible deal is just straight common stock. As that's the basic baseline stock. That's what the founders will typically take and get. That's the general stock of the company. And in an early stage, sometimes folks just come in and share common. If that's the case, one of the things that's critical, and indeed this is critical even if there are just founders at this stage, is some kind of agreement among those stockholders. A shareholder agreement, a founders agreement, if it's just the founders, something that will spell out who's going to be on the board, how it's going to be voted, who has to approve a variety of things. There's going to be the need for a deal of that kind. So if my Aunt Matilda comes in, Aunt Matilda, if my Aunt Matilda comes in and invests in my company, she puts up $50,000. Thank you, Aunt Matilda. She comes in and does that. That's terrific, but we're probably going to want to have some kind of agreement with her other than just here's your stock. As to what it looks like. So again, straight common is possible. In that context, the stock itself will not typically spell out the deal, and it's very useful to have an agreement sitting on top of that of some kind that will set up the various ways. Often called a shareholders agreement. Any questions on sort of that sort of straight common, just coming in like a founder and being an investor at that level? Another way that people come in is, particularly in the earlier stages, is through what are called convertibles. And the convertible is essentially you get some money and from the investor. The investor doesn't get stock yet. The core deal is they will get stock, and they will get stock in accordance with whatever is the next priced round. A priced round is what we call when we actually sell stock at a fixed price to some folks. We'll get down to that when we get down to the series stock. But essentially it says, hey, when that comes in, we'll get that, but we'll get it with some kickers. And the 2 typical kickers are, one, some kind of discount. So if the priced round is selling shares at $5 each, Maybe we got a 20% discount and get it for $4 each, for as our bonus for having come in early. So that discount. The other thing can be is a cap, and the cap is a valuation cap. So the valuation at which our shares will be calculated will be set with some kind of limit, so that if the cap is at 5 million and the investment comes in at 10 million, we'll not get twice as much stock as the people who are coming in at 10 million, because our cap says we will be denominated as if we're at 5. So a cap or a discount or both can sometimes be offered. Those are the typical inducements which are offered in a convertible context. Now, the convertible debt is essentially lent money, and it is officially lent, and it can be owed back. It's officially debt. It can be awkward if typically it's not called for 3 years or so, but if there hasn't been a price round in 3 years, it gets awkward. You owe the money back. Also, with that convertible debt, there's often interest that comes in that should be taken into account. That interest is often just converted into additional stock, but it's a kicker that's in there that needs to be kept track of. The SAFE is a relatively new instrument, developed really in the last 10 or 15 years by an accelerator out in California called Y Combinator. Y Combinator does some wonderful work. Y Combinator put together this documentation as an alternative, and the SAFE is an interesting form, because it says basically we're not lending you the money, we're giving it to you as an investment, but it will become it'll become stock whenever that price round goes forward. And we're just sort of sitting out there waiting for the price round. And when the price round happens, boom, it will convert. Typically, it doesn't carry interest. That may mean that the discount's a little higher instead. What it also does is if the company is sold or gone out of business or whatever before the conversion, then there's a different set of rights that kick in. So it's not like the money doesn't have some rights while it's going forward, but essentially it's kind of on a holding pattern, waiting until we have a priced round. Then it will shift into that price round, subject to discounts and things. Also, sometimes the safes have side letters, a little bit like that shareholders agreement. Those side letters sometimes, if particularly it's a significant investment in a safe, might say, hey, you won't take money from our competitor, or whatever it might be the case. So sometimes there are side letters involved in the safes as well. The core form is supposed to be standardized and not supposed to be messed with. People mess with it a little bit, but basically the whole point of it is why Combinator was putting this out was a relatively neutral deal that people could just go to without heavy negotiation and just accept and say, hey, here's some money, here's the safe, here's the discount, here's the cap, here's the document, you can sign tomorrow. Okay. Questions on convertibles?
Oliver,
Yes.
We've got one from Lee. Go ahead, Lee.
Yeah.
So I have like 5 safe agreements, and all of them have a 25% discount. Describe to me what that discount is on and how they benefit from that discount, please.
Here again is the point. Suppose that we have the safe is put in $100,000. And that $100,000 will be converted into stock along the sides. Now, if we have an offering with a $5 million valuation, $100,000 would normally be one. Come on, Oliver. Is that? I'm trying to do the math in my head. What percentage of 5 million is 100,000?
It's like 2%.
2%. 2%,
Yeah.
is it? 2%. So that 100,000 would get 2% of the stock. Okay. If there's a 25% discount, now we say, oh, except for the fact that instead of costing, 5 million at that investment, now at 25%, that'll be at 4. So essentially, we'll apply the $100,000 to $4 million, which means we get a bump of stock. Okay. So the discount means in that conversion, whenever it takes place, that they will get they'll get extra stock in the deal. Because basically they've been told they will pay 25% less for their stock than anybody else who's normally in the deal.
So the 25%, if you were doing an equation, is 25% off the value, the current valuation of the company, with the same percentage applied to that. So there's a small bump Did I get that? Did I explain it right?
But yeah, I think so.
Okay.
That's essentially it. That basically, instead of getting 1-for-1 with the folks in the New Deal, they're going to get 1 plus 25.
Got it.
Okay.
And I think maybe a key detail here that's kind of easy to miss or that can be confusing is that the valuation, how much does the stock cost? It's set by the amount of money that comes in during the priced round, which we're going to talk about. So, that can be a little confusing sometimes because, what is the price per share? Well, that depends on how many investors come in and how much they buy.
Right.
And
Now,
we end up with the valuation
it
of the
works
company.
back and forward that way because we
Yeah.
can say, here's the price, come on in. On the other hand, depending on who you get and what they give and how much you give, that's the other side of it. And the two really work together. The sort of valuation question for the company is really a negotiation. There are people who claim there's some science to it, and there's a bit, but it's essentially a kind of, what can you get from these folks coming in, and that's going to set the price. But once that price is set, the folks with safes with a discount get a discount, and they get some extra stock as a result.
And how big is a safe typically? What is the ballpark investment size for safes?
It's quite variable. Depending on where and how. My company had a deal for 10 million in safes. We started out in rather less, and where we were happy to get 20,000 in safes because we were starting with early stage capital, and 20,000 was very useful early on. As the company matured, it got bigger. Safes can handle whatever. Up to a certain point. Just again, depending on where and how they go.
Thank you.
Okay. Cool. Any other questions on safes? Classic preferred series stock. Now, this is the sort of the classic venture deal, but not only is it the classic venture deal, but it's also the classic deal for many other forms. Private equity deals will often take a similar shape. Industry deals can take a similar shape. When folks do this, this has become the sort of standard approach to this. And what this says is essentially we're going to create a new series of stock. And it's going to look a lot like common stock, but it's going to have a whole ton of extra protections and other things. It's going to be a series of preferred stock. And sometimes that Series A is seen as a benchmark as the first series, although often you can have a seed series. Again, my company had a Series Seed, and then eventually a Series A. And oddly, the Series C was bigger than the Series A, at least in new capital. The Series A we used to essentially clean out a bunch of safes and sort of update the capital structure. But the whole notion of a series is that there can be additional. There can be Series B, Series D, C, D, etc. There can be additional series as they go forward. The protections are significant, and I'll summarize some of them. By the way, there is a standard set of documentation set out by the American Venture Capital Association folks that is available online. They have both the term sheet, which sets the foundational outlines of the deal, and then the actual stuff for the charter for the certificate of incorporation, which sets the terms of the stock. There are also 4 or 5 other agreements about voting, around reselling the stock, around the rights of the investors. There's a whole set of different agreements that go forward. It is a very paper-heavy deal. There's 100 pages plus of documentation that goes into this, a deal along this line. Sometimes in a industry or a private equity style deal, that some of that can be cut down. Again, that's a good thing in some ways because the VC protections are often quite exhaustive, and some of them can be negotiated out as one goes forward. What are some of those things? Well, one of them is that folks often get what's called anti-dilution protection, which means that if there's what's called a down round, that's if stock is sold at a lesser valuation, then the investors will get topped up. Hey, we'll get topped up as if they had got the deal at that lower price, and that topping up comes out of the share of the founders. So the founders get penalized. Why, you would say, hey, you bought this stock at that price. Don't you take the risk of that? And they say, yeah, except we don't want that risk because we're VCs and we don't want risk. So you're going to top us up if go. That's one of the things that's there is this anti-dilution protection. Then there's the exit price that they get. They get a minimum price typically on exit, which may just be what they put in, maybe what they put in plus some interest, maybe what they put in plus a multiple of some kind. So if there is a sale of the company or a sale of its assets or whatever it may happen, there's an exit, they will get the right to line up first. Now, if the exit is a down exit, in other words, we raised $1 million and we only sold for well, let's say we sell it for 17, we got $10 million in. There's a little profit there, but the VCs may only have 30% of the company, but they're going to get their full 10 million back first because they got that priority, that preference. So there's a liquidation preference and priority that comes in, and can leave the founders even in a profitable sale with little or nothing to go forward. Um, um, Marie, you were saying a pre-revenue. If pre-revenue startup has only received, I was just looking at that. Is there a question that goes with that statement?
Hi. Yeah, I was wondering if your small business has only received money revenue from grants like SBIR grants or other grants. Does that investment contribute to the small business's valuation?
Well, obviously, valuation, it takes in a number of things into account. And one of the things it takes into account is current actual revenue. Are we revenue positive? That people like to see companies that are making money. Oh, cool. Also, the whole notion of potential comes in. Those grants, if not bookable as revenue, still are a vote of confidence. If the company is arguing about valuation with a potential investor, the company will say, "Yeah, we don't have any money, but look at the confidence the federal folks had in us with this, and look, therefore you should give us X, Y." They'll come back and say, "Yeah, but there's no income, and there's no actual income. We should give you, we should give you less money and get much more of the company." My company, we sold. If I may I share some? My company sold at approximately 100 times actual revenue,
Wow.
which is a pretty good multiple. But it was because we had a lot of promise, and early stage, the company was just doing the hockey stick thing in terms of customers, and we sold to some folks who were business collaborating people and investors who knew what we were and said, "Yeah, okay, we'll get you. You're about to be wildly profitable. We'll take you now." And we said, okay, because we needed some more money to get there anyway. So it was either that or a diluting raise that went forward. So that worked out fine for us. Again, it's not a science. It's like, people will claim that, yeah, you need revenue. So as you say, a grant is different from saying, "Hey, we got $1 million in actual revenue," but it's, you can say, "Hey, it's a really strong indication of confidence by people who know about it," and that yeah, we're not making money yet, but we're pre-revenue, but we're strongly pre-revenue, and we need some money, and we want to sell it to you on a good deal. Kat, would you feel have some insight on this?
Yeah, thanks, Oliver. Oh, I honestly don't, but one of our advisors is specialized in SBIR, so I have a note to check in with him and see if that's ever been brought to his attention because I'm curious to hear his thoughts on it. I'm going to share my information at the end of this as well. So Marie, if you feel comfortable reaching out to me or providing your info, I'm more than happy to circle back. But really great question. Yeah.
Yeah.
Great.
And as I say, there's no, valuation is not really a science. Valuation is a persuasion. And one of the elements of persuasion is we've got income. Another element is, hey, look at what the government thinks we're potentially good for, and so that I would go back and forth with that. Is that helpful?
Yes, thank you.
Okay.
Thanks.
I could probably add a little bit to that, right? When we think about the valuation of anything, the value of a thing is what a person will pay for it. And so then we get into all the questions about, well, how much is somebody willing to pay for a share of my company? And things like grant eligibility or other kinds of, federal programs definitely going to play into that. If we think about early, Tesla, for example, if every car gets a $7,500 price cut based on the federal program that existed at the time, obviously investors are going to be interested in that and are going to price things accordingly. So, all that stuff plays in, but it's to Oliver's point, it's more art than science to think about valuation in early stage companies.
And there will people who will make it sound like it's a science if that argument then helps them to make the price come down, Okay. They'll say, oh, no, 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 no. And then they just say, oh, well, hey, that's one valuation basis, but how about on this valuation basis? And on this one, it's sky high. It really is a persuasion. All right. So other aspects of this, so there'll be minimum return. There'll be the dilution protection. Often they'll want a seat on the board, one or two seats on the board. They'll want to have a variety of input. They'll want to see some other aspects which aren't necessarily founder friendly. The founders we've got a slide later on this, but the founders will be restricted in their sale. They may have their stock subject to divestment. There's a bunch of things that go with this. In that 100 pages are a number of things which are not necessarily founder friendly. And one of the things I say to folks when I'm educating or as clients, I say raising money almost always involves accepting a deal that's worse than you'd like. And the trick is to make sure it's not a lot worse than you'd like. But rather, the equity is going to be given up. They're going to want to handcuff you in some way. Negotiate hard against them, but almost always somebody's going to come down to, hey, they want to get into this deal. Cool, that's good. But they also want to have opportunities to tie it up and other things. And again, in my company, we were able to resist a number of these things, partly because we did not have a classic VC deal. We had the classic looking preferred series stock, but we did it often with folks who were industry partners and otherwise not as out to restrict us and tie us up as a VC might have been. Okay. Are there questions then on the classic preferred stock route? If folks are interested, there's a lot of literature on this, and the National Association of Venture Capital, I think it is the NAS VC documentation is available online, and all hundreds of pages of it. It can be people can see it in advance and have a look. Exotics, other ways of doing some of this. Some of the exotics might be warrant kickers, warrants are the right to buy stock, so are options. Options typically if given to an employee. Warrants are similar, but they give the holder the right to do. One can issue warrants. Typically at a price that's higher than the current price would be. Why? Because there needs to be some growth into it and some success. But those warrants can sit out there. Again, a company I was involved with, we gave a bunch of warrants in different ways to give incentives to have different things happen. And those warrants, eventually were in the money, and folks did rather well out of having helped us at a key moment. Again, they're kind of kickers that can be added into a debt deal, into some kind of a partnership deal, in all kinds of different things. Options again can be given more typically to employees. A qualified stock option plan is something that many early stage companies get in place. There's a whole bunch of tax rules applying to that, and it requires getting outside valuation and having the issuance be pursuant to the plan and be pursuant to that valuation. And excuse me. Got what the British would call a lurgy this week. I'm a little under the weather. But again, if one wants to do a stock option plan, it's critical to get competent counsel to help set it up, because they are picky. They are what they are, and also recognize that they will be dilution. By the way, going back, remember the anti-dilution thing would be in the VC style deal, which says if you give other stock at less price, one of the things you're doing when you're doing a stock option plan is you're doing that. What you really need to do then is make sure that is that has been exempted out from the anti-dilution provisions. Again, that's just kind of the technicality that's involved in that kind of thing. Also, any warrants that you might give out should be exempted from that anti-dilution provision, so that these commercial things that one is doing don't come back to bite with that anti-dilution protection, taking money from taking control and stock from the founders typically. Questions on the exotics? Then the final thing would be might be bridge debt. We talked a little bit about debt and those other debt things that are out there. One of the things that might be out there is sometimes you get bridge debt if we're negotiating a deal with a VC and we're running low, our runway is shortening. The runway is always something to keep track of. Just how much capital do I have and what is my burn rate and where am I going with this and when do I have to lay everybody off or shut it down or whatever it is I need to do. The VC may come in and say, hey, we're still negotiating. We'll give you an extra $1 million here right now. The terms of that may then just absolutely handcuff you to that VC. So just be aware that those bridge debt pieces are not necessarily altruistic. They if they want to do the deal now not only do they're the only source of capital that you're looking at, they're also now you owe them $1 million as well. There we go. You better hope that you like them as a long-term partner because they're gonna negotiate with you with a little more steel in the glove than they would have earlier. Then there are these other debts, as Kat was saying, that there are the small business loans and that sort of thing. I'm not going to talk about those deals here in this context. Happy to in some other context, but here we're really looking, as I said, at the equity aspects. Questions? And at least in my experience, what you're going to see is some version of these things typically, because even in deals that are not with venture capital, the classic series preferred model has percolated through the marketplace and is very often what one sees. Okay. Next slide. Governance and other founder concerns. Okay, these are things that are some of the things that are in there that may come back to bite the founder and the things the founder should be taking account of going forward. One is board and other governance matters. As I said, the venture capital deal standardly appoints at least one representative to the board. They better be folks you like. Also be aware that keeping a majority of the board in the hands of the founders is a very important piece if the founders want to keep control. Even a balanced board, sometimes the VCs will come and say, well, we'll have 5 members and 2 will be from the founders and 2 will be from us. And then there'll be a balanced person. Even in that context, guess what? We've just given away control. That balanced person may or may not side with us. We have given away control of the company. And what we don't want to have happen is that control in any way to allow them then to fire us, because there can be a cascade of consequences from that. You are fired. The 3 out of the 5 board agreed that the founders should both be fired. What does our employment agreement say? Well, what does it say? What does our side deals on control say? Does it say that we still stay on the board, or does it say so long as you are employed or a consultant to the company, you stay on the board? Guess what? You're gone. They have scooped you out, as they say in sort of Wall Street parlance, and thrown you away. You don't want that. And that'll tie into some other stuff going forward as well. So again, be very cautious about granting seats on boards. Sometimes one can grant observer status. Sometimes folks will take observer status. They get to show up, but they're not going to vote. Cool. They're showing up. They're not voting. That's a better piece. Although if they're showing up, one has to take care to make sure that the observers get all the same notices and get the rights to attend and all that stuff. Because a board keeping good records of legally authorized board action is one of the key things going forward as we get down to due diligence. A related question is the founder's stock vesting, divesting, and dilution. Dilution is to some degree inevitable in all this, but again, it should be kept track of. Over time, the amount of money, of a percentage in the company can shrink. Again, in my own experience, the amount of my ownership of the company shrank by a factor of 5 from all the different pieces that we diluted and we set out and we did other things. On the other hand, the eventual sale was a nice price, so it was still an okay thing. You gotta just accept that there's going to be some dilution, but what we don't want is to have too much. I mean, try and keep that. Just keep your eye on that factor as you go forward. The vesting and divesting is a little diabolical because sometimes the venture capital deal will say, "Hey, founder, your stock, you own, yeah, we're going to leave you with 70% of the company. We're going to take 30% of the company for this, but that 70% of the company is now subject to divestment if you're no longer employed by us." And it may be on some kind of schedule, so that a quarter you'll get to keep a quarter after the first year, you'll get to keep a half after the second year, 3/4 after the third year, and the whole thing after 4 years. Well, okay, that's meant to keep you in line. But on the other hand, if they say if they have the right through the board to fire you, and you're subject to that divestment. They fire you after a year. Guess what? 3/4 of your investment, of your ownership of the company, just went away, not because you quit, but because they. So again, if there is a vesting or divesting clause in the deal for the founder's stock, that should be very carefully attended to, and should probably have an exception for that. It would only apply to voluntary leaving. That any involuntary termination or death or whatever would not affect that ownership. Due diligence. Questions on any of that, by the way, on the board and governance and the vesting and divesting. Again, nice problems to have. If you're having to negotiate this, that means you're probably raising $5, 10, 15, $20 million. Woohoo! But on the other hand, it is the kind of thing that comes up in these larger deals. Or even to some degree in some of the smaller ones. I know if there's sometimes these things will crop up even in safe side letters for a few $100,000. Questions? All right, due diligence. Brian, would you take over due diligence, because keeping
I sure will. Yep.
Having good records and all that, and being ready for them to look is an important piece. Go ahead.
Absolutely. And actually, before I even get into that, I'll mention. So just with respect to these governance matters, investing, divesting, dilution, we're going to talk about stock sale restrictions and so on. One of the key subtexts behind all that is this difference between ownership of the company and control of the company. And for anyone who's interested in kind of delving into an interesting case study in that regard, you could look at Facebook, then Facebook, now Meta, and its owner, CEO, Mark Zuckerberg, who did some very creative things in the early, years of the company to maintain control of the company despite losing quite a lot of ownership in the company. So a lot of dilution happened, but there were provisions in there for maintaining control. I say this as just a way of pointing out that there is a lot of room for creativity here, which is both good from a founder's perspective, because whatever deal can be imagined can be enacted. But it is also bad from a founder's perspective, because sometimes the imagining is happening on the other side of the table. And to Oliver's point about founders getting booted, that can happen because founders were not well represented or didn't understand the deal they were making. So,
and Brian, if I can just elaborate, it's an excellent point. The way that Mark Zuckerberg did that was that any share of stock he owns gets 10 votes, and every other share of stock basically gets 1 vote, so that he can own as little as 10% of the company and still have almost the same voting power as everybody else. So that was sort of the technique that he used and could be used by others.
Yeah, a good example of a very creative technique, but is possible to do. So let's talk about due diligence, which plays into all of this, because we've been talking about all these different agreements, and there's the potential for safes and side letters and all these other parts and pieces which go into funding a business that is trying to scale or that is trying to accomplish something with money that it cannot raise on its own. And we end up with, or can end up with, quite a stack of paper that has been generated during this process. The due diligence is the process of the founders or somebody basically digging through this giant stack of paper to find out what's happening with the business. What exactly is its position vis-a-vis the world, any early investors, among the various owners and board members, and the relationships between them and among them. So when we think about this process, and this is a process that a company can expect to go through before it takes any formal outside investment. So if we think about especially VCs, for example, but others as well, they're all going to want to know what specifically is the condition of this business right now. And it can range from the very basics. Is the business keeping up with its registration at the Secretary of State in its place of incorporation? So if it's a Delaware corporation, is it in good standing or isn't it? Right? That's a very basic thing. Up through, what do the bylaws say? Let's look at the meeting minutes from the various meetings that have occurred during the tenure of the business as it has been run. Is everything clean? We could think about this in terms of what we can think of the white glove treatment, right? Where we get somebody who's coming through a house that has been cleaned and they have their white gloves on and they're looking behind the mantle and behind the photographs and looking for little bits of dust that they can sweep off with that white glove and say, this isn't perfectly clean after all. So it's this corporate housekeeping and making sure that things are in order so that when the VC or the other investor is coming through to figure out what is the condition of the business today, are there any skeletons in the closet, we'd like to find those before they do and perhaps clean them up or at least be prepared to talk about it if and when your investor finds whatever it is that makes their white glove less than perfectly white. As they go through. Oliver, do you have any? Did you have something you wanted to
No, I would add just a little bit. This involves both sort of the stuff at this time of sale and also just attention to detail going forward. We all are a little casual about our lives, hey, did I get that bill paid on time? Let me go check. What one can't be really is as casual about a company that is looking for this kind of national investment level stuff. As Brian says, they will come in, they will look, they want to see the books, they want to see the records. On the corporate side, they want to see was every meeting appropriately noticed? Every meeting of the board, was there appropriate notice? Were there minutes taken of it? Were those minutes in a form that were ordinary and normal? Were the compliance aspects of having employees taken care of, where all the tax returns were done. These are all, everything that could come around and bite the company later on from having been a little casual or whatever. That's what they're looking for and say, no, too casual. Either fix it or we can't do the deal. And a lot of it can be fixed, but then you're paying expensive lawyer fees to go back and do a bunch of stuff that's catch up. The real trick to this is to be really just careful about doing the right thing and keeping good records that you've done the right thing at a level of attention to detail, which is a little harder than many of us are able to do in our normal lives. And then, Brian, you might want to mention that one of the areas of this often is intellectual property and the agreements that goes with that.
Absolutely. Lee, you've got a question? We can start there, and then I'll.
Yeah, I do. I'm wondering if you have like an index of what should be in the data room.
Okay. Yes, a good point, because a lot of this then goes into what's called the data room, which is the place where all this gets put. Typically, the other side will have some kind of index that they all want, but in my experience, there's going to be a section on all the corporate stuff. There's going to be a section on the tax stuff. There's going to be a section on the employment stuff. There's going to be a section on all the contracts. There's going to be a section on this intellectual property piece that Byron's going to talk about in a little bit. The central pieces often in the agreement for capital is a list of what's called representations and warranties, which are the promises of the company about their having clean records and clean, all the stuff that might be concerning. That representation and warranty list is often reflected back into the data room because that's the stuff they're interested in. And
Is there an
again, I'm sure
outline?
online there are I suspect 3 or 4 different places that'll give you what a data room should have in it. They will be variable, and again, that's because there's nothing that's absolutely standard. But what I'm talking about is the kind of thing that they will typically want to see. By the way, access
Yeah.
access to the data room should only be given after some agreement of non-disclosure has been entered into.
Yeah, I agree. I'm looking for kind of an outline just to make sure I got everything in my data room that I should have. So if anybody has it, that'd be awesome. I mean, it's a high class problem to have somebody ask you for your data room. So
Yes, no, it is a very, very, very good problem to have, but it is one the kind of thing, and one wants that data room, which is the sort of the accumulated piece of all this record keeping, to be good. If one is posting to that data room and is putting up stuff that really isn't very good, I know that all one is doing is creating problems for oneself going forward. It is an opportunity to self-assess as to how good it all is. And I should say, by the way, this is not trivial. This is foundational to getting that money.
it is. Yeah.
Yeah.
Brian, we interrupted you on IP because IP is often a very considerable piece of this quest.
Yeah, absolutely. So we've been talking about tidiness and making sure that the company is tidy and clean and that things are understandable and clear and that things have been done properly throughout. Of course, investors are also going to be interested in the assets of the business. So, this is also foundational. What is the business worth today? What assets does it have? And intellectual property is a main category of those kinds of assets. Warren Buffett, I think, was the one who coined this term, or at least popularized the idea of a moat being built around a business. Warren Buffett likes to invest in businesses that have a nice wide moat built around the business. What does he mean by that? He means that competitors cannot come in and just eat the lunch of the business by finding ways to compete better, faster, cheaper, and make the same product or offer the same service. So how do we make this moat? I mean, there are many ways to do this, but one of the main ones is intellectual property. So that's copyrights, trademarks, in some cases especially patents can be crucial for a business. And these things are going to be scrutinized by venture capital or other investing firms. They're going to want to know, is the intellectual property of the business registered? Has this been done, throughout and timely? What is the sort of status of these registrations? Are they issued? Are they just pending? Especially in the case of patents, they might even get into the details of, well, do you have broad coverage over your invention or do you have narrow coverage over it? They might get into some of that detail. But they're certainly going to be interested in, is all this stuff been registered timely? Is it being maintained? Have the various fees been paid? And the business needs to be ready to come and show that, yes, we have our copyright registrations. Here's the list of registration numbers because we went to the Copyright Office and got this stuff registered. We've got our trademarks covered for whatever our important branding is. And again, here's the list of the, either pending or better yet registered trademarks that we've obtained to protect our branding from folks who might try to rip us off, right? And same thing with patents, right? We've got pending patent applications, we've got some issued patents, everything's maintained. Here's the list of, that various IP and, maybe some reps and warranties over what kinds of due diligence we've done in connection with our own ability to register intellectual property and, in some cases, our expectations of not running afoul of other folks' intellectual property. Sometimes that's going to show up here, where maybe we've been interacting with intellectual property counsel to make sure we're not going to run afoul of somebody else's patents, or that we have sufficient distance from somebody else's trademarks, and we don't think we're going to have any trouble here, right? So these things are going to be of interest to investors, and they're going to want to know precisely what has the company done and what is its standing vis-a-vis IP.
And just to supplement that a little bit, one of the things is ties back into is on the employment side is making sure that all the employment and consultant agreements and everything have very good, strong grant language back into the company from any IP that has been discovered. That's I have occasionally had to chase a former consultant and get them to sign something with very little leverage because it had been casually done and just wasn't there, it wasn't in the file, and that kind of attention to detail on the IP is critical. By the way, Lee, I went and looked it up. Asked Google for lists of data room. The Google AI list was reasonable, but they also cited Carta as a source. Carta has a data room list. There are some companies, by the way, that will run your data room for you. I don't know whether you want to spend that money or not, but they're out there. Carta is, if people haven't come across Carta, it is a very interesting company. It manages the stock tables and capital table quite well. Again, I've used it in the past myself, and they have other ancillary services. They do the valuation piece for options. They also do. They have things like data room, and their list looks to be again a useful list if you're looking for just outside sources on what might be there.
One more question for you, and Brian. On patents, we have IP, we have trademarks, we have a trade secret process. Everything is duly, wonderfully documented. The question is there a way to sort of project the value of licensing patents that could go into your financial model? Is that persuasion, Oliver, as you described it? Or
it is. Yeah, I mean, there's semi-science attached. Brian is a very skilled IP attorney and has seen examples of this. Brian, you want to talk about it a little bit?
Yeah, sure. I mean, that is a cottage industry unto itself. Valuation of IP and patents in particular. The questions that we're going to be asking are. First of all, what patents do is they prevent others from making, using, selling, offering your invention, right? And so then the question becomes, well, what's the invention? Well, the invention is defined by the claims of the patent. Okay, what do the claims say? Are they broad claims? Are they going to prevent anyone from making anything even remotely similar? Or are they fairly narrow claims? And then we're right back to sort of valuation land, where we're thinking about, okay, let's assume we've got broad claims. We can prevent anyone from making our widget or any widget that's similar to our widget. We basically have the entire market locked down for some period of time, right? Maybe it's a patent lasts for 20 years from the date of filing. Maybe we've got 15 left to run. And so we've got 15 years of exclusivity in this space. And now we're asking the question, okay, how many newcomers may come along and try to compete with us in this space, but be prevented from doing so by our patent? And so how much revenue will our company get as a result of preventing that other company from ever getting off the ground in the first place because of patent infringement concerns or actual problems, right? And so that's kind of the process, the thought process that goes into evaluation. And of course, there's lots of thumb in the air, how is the wind blowing, and making estimations. But it is a process that can be undertaken.
And another set of factors in that would be who owns the patent. Because if I own the patent, I can't do much with it. If Megacorp owns the patent, they can pour a lot of capital in and exploit it. So again, they're quite moving parts on that one as well. Say, well, Megacorp, if you're looking to buy it from me, you have to pay a premium because you're going to actually get much more out of it than I could.
Right.
That is exactly where I am right now with a big engineering firm wanting to license the patent. I have no way to deploy that patent but it's a great idea. And so how do I value what that opportunity is? I guess that's kind of an art form, right?
Brian, this is your wheelhouse. One of the things is that Brian is actually a very, very good and experienced patent attorney. And while we don't want to advertise his private practice side of this thing, this is very much what he's up to. Brian, do you want to give a?
Yeah, totally. I mean, if we're thinking about it in those terms, right? So we're looking at, well, what is the value of this patent to this potential buyer? Well, they're the ones who have the opportunity to scale this invention, and they're the ones who will then benefit the most from being able to exclude their competitors from doing so. And so if they are looking at either an exclusive license to the patent or just buying it outright, then they're the ones who will get all that benefit. Now, of course, they're going to come back and say, yeah, that's all great. Of course, you, the seller of this asset, it's not that valuable to you. It might be that valuable to us, but it's not that valuable to you because you're not in a position to, manufacture these things at scale or whatever it is. And so that's all going to get into this negotiation. But, the seller is going to be interested in what precisely can the buyer do with this technology and what kind of markets does this open for them, that they can then remain closed to their competitors. And we get right back into like a substantive claim by claim, in some cases, analysis in high value negotiations where we're saying, okay, but what specifically are the competitors prevented from doing, and are they going to be able to design around the claims of our patent and essentially end up competing with us in the marketplace even though they're not at least technically infringing? Surely the competitors are going to try to do this. They always do, right? If it's a high enough value technology space, competitors are going to try to find a way around it. Or they're going to push down on, let's say, potential licensing fees by saying, yeah, I could take a license from you, or I found a way to design around your claims. I know a way to do this differently than you've done it and differently from the way you've claimed it, where I'll still compete with you in the marketplace, but at least plausibly not have any problems with infringement on your patent, right? And so this gets into a big back and forth very quickly, and lots of peering into the crystal ball and predicting the future is necessary to come up with a number.
Okay.
Great. Any other questions on due diligence aspects? On the one hand, we don't want to scare people, but on the other hand, making sure that the due diligence housekeeping has been done is a big piece of it. Marie, you had a question?
Yeah, I was just wondering, maybe this is for Brian again. If you were in a position to have a conversation, if I say was in a position to have a conversation with a potential buyer, at what point would I want to get my IP attorney involved with me? Is it something like, do I go have a lesson from him before I go have that meeting, or do I bring him with me, or
Yeah,
do we negotiate through that process?
right. Well, there's a couple things that an attorney would be useful for in this context. One of them is just making sure that the IP is up to date, right? That all the fees have been paid, that we understand where in the life cycle it is. Are we talking about a patent application which is not yet issued versus an issued patent? An issued patent gives a right to exclude. An application is a prospective right to exclude, but it depends on getting past the patent examiner, which can be challenging sometimes. And then if it is an issued patent, we're asking, well, maintenance fees are periodically due. Are those up to date? Or have we paid up on that? Or do we have a skeleton in the closet? Maybe a maintenance fee wasn't paid and we're in a grace period, or it wasn't paid and we're outside the grace period, in which case there's no discussion to be had, right? So lots of other stuff like this. Sometimes we have further continuing patent applications which can be filed off the original to sort of retain optionality for future claim coverage, specifically to try to get to address some of this design around stuff that people do, where we say, well, we've got open prosecution. I've got another patent application pending. I'll write my claims to cover the thing you're trying to do design around, person, right? And so that can be valuable. So to the extent that either A, there's a sort of foundational question about is this IP current right now, or B, we're getting into details about claim coverage, the sort of how much are we really going to be able to exclude competitors and so forth, then an IP attorney can be helpful for those kinds of discussions. On the other hand, if it's just, I love your technology, our internal people have done our due diligence and we don't see a problem, we want to buy the patent, let's talk about price, right? And nobody's arguing about claim coverage or anything else, then it might not, be as useful to have an attorney hanging around.
If I may make an analogy, it's a little bit like you're trying to sell your house. Do you have your engineer come in and give it a quick inspection before you put it on the market so you know where the problems are, or do you wait for them to find out? And depends partly on whether you can afford to pay the engineer to come in and look. And early knowledge is almost always useful, but it does come at a price.
Thanks.
Stock sale restrictions. One of the things that founders find often that they have in these agreements is they can't sell their stock. Even if they didn't get it divested, they probably are locked in for selling it. They can only sell it in contexts where the other investors get to join. This is very, very common. That prevents the founders from doing sweetheart deals with somebody taking over their position and then leaving the 30% that's in the hand of the investors, sort of high and dry, as it were. So basically, the founders are locked into their stock. There are often exceptions. They can sell they can sell to the investors. They can sell back to the company. There are exceptions in this, but they are exceptions in that context. Preemptive rights, ROFRs, etc. These are things that sometimes get attached. Preemptive right is a right for somebody who currently owns stock to buy in the next round. So sometimes the investor in round A will get in Series A will say, "Hey, we get to invest on the same terms as everybody else, but we get to be an investor in Series B, Series C, etc." That kind of locks them in as a customer. On the one hand, you say, hey, you want to invest if it's on the same terms, do we care? And we don't necessarily care that much, but it does restrict if the folks coming into Series B want only their VCs and the old VCs have a right to come in and buy a piece. Anyway, it's a restriction. Somewhat more important are ROFRs, rights of first refusal, and things like that. Rights of first refusal basically say, hey, if you ever sell the company, you got to come talk to us. And then A, you got to talk to us first. And B, we get a right to match any other deal. This is a big inhibition on other deals. Doesn't disqualify them out there, but it means that basically if company A comes to me and says, "Hey, will you sell your company to us for $20 million?" Now you got to go back to your investor and say, "Hey, investor, we got an offer for $20 million. Do you want to buy it for $20 million?" And this inhibits company A from even coming in and talking. Less inhibiting, but still out there, sometimes information rights where you don't have to make the offer to give company B, the investor company, the right to match, but they at least have to give them information. Say, hey, we have got this information. Just FYI, and you do with what you want. If you want to come in and bid, you can do. Again, in a good circumstance, this can create a bidding war, which is fabulous. You want a bidding war. What in a bad circumstance, it inhibits the offer from the other side. Tends to make them grumpy because why are you telling on the other side all this? Because you're supposed to. So anyway, that they're there. There are other sticky terms. There are terms that might perhaps if your investor had a commercial relationship with you, is that commercial relationship cancelable? Again, what are the terms that have been put in here that are beyond just I'm just a straight investor to I'm a straight investor and I'm a commercial partner. I've got these ROFRs. I got all this stuff that makes it deal sticky to me. That's an important set of considerations. What are we trading away? Well, there are folks coming in with money, particularly industry money. Sometimes the VCs will want to make it sticky. You want to make it less sticky. Again, back and forth is a negotiation. Questions on any of that? Okay. Woohoo! I think we're on to the next slide. Yay. SEC, because if raising capital makes one subject potentially to the SEC. Securities Exchange Commission. They come in and they are ferocious, even with their somewhat tame state these days. They can be ferocious still. Um, um, they are what this is typically about is finding an exemption because the sale of securities and stock or any of the things we've been talking about are typically going to be a security. Sale of a security using interstate commerce, and interstate commerce includes telephones, faxes, internet, any of that stuff. Then is subject to their rules. So almost any raise in the United States, unless you're just doing it out the back door of your cabin in the woods of Vermont, and people are walking up to see you, is going to and not using money. Anyway, it's just you're going to be subject to the SEC. So how do we find an exemption? There are two or three key ones. The entry level one is something called statutory 482 exemption. And because statutory 482 says these restrictions that we're going to then go on and describe in greater detail in what's called the 1933 Act, the Securities Act of 1933. These restrictions will not apply to offerings by an issuer. That's, the issuer is the company issuing the stock or other security. The offerings by an issuer that do not constitute a public offering. All right, cool. If it's not a public offering, it's exempt. But that exemption has not been defined very well. The statute does not define it at all. The courts have given it some definition, and the SEC has given it definition by regulation. But the regulation under Reg D, which we'll talk about, excuse me, regulation is not the only avenue. This is what's called a safe harbor. It says you do this, you're safe. But other things that are not public offerings under 482 won't be. So what does that mean? Well, if you're selling to family, fools, and friends, people you know in small amounts, not using any significant advertising or other marketing materials, and it's they're people you know already, smallish amounts, no big interstate offering, etc. That's probably a private offering. I mean, that's probably a private offering. And instead of going all the way through Regulation D, one can say, hey, it's a private offering under 482. We're just not going to bother with that. Two things that still keep in mind. Second one, which we'll do first, is state blue sky laws. The states may think you now are an offering, and you may end up having to meet the law of the state, particularly the state where these investors are resident. Many states have exemptions. They're what's called state blue sky laws, and they often have exemptions for 3 or 4, 5 offerings in state for people who not involving any advertising, etc. Again, the rules are there, but there's a form you've got to file to stay ahead of that. So being aware of what that is and just taking care of it, that's important. Why? Because when the due diligence comes through, if you don't do it right, then people can sue you. But B, when you come around to actually raising the big money, now they will look at, what was the basis of that offering? And so that's a box to check, is why that was good. So keeping track of why each of these is good and making the required filing both good in and of itself and good for future fundraising. Also, be aware that disclosure obligations don't necessarily go away. There is, although the mandated disclosure obligations, we'll talk about a little bit later, may not be applicable. Nonetheless, it is important to recognize that Rule 10b-5, which is a federal rule, says that you may not use schemes or artifices to defraud, and also you may not lie affirmatively in any information you provide an investor. Okay. And also, you may not lie by omission. You may not omit to tell people, which will make the information you did give misleading. So information packages, decks, all that kind of thing, they can run into this. A deck is this kind of as a disclosure document, and should be couched, should be accurate, should be have some disclaimers in it and that kind of thing, because a deck will count. So be very aware of disclosure and also of the state blue sky laws. Now, second big exemption, and this is the one that actually is more popularly used, is Regulation D, Reg D. Reg D is the big exemption regulation put out by the SEC. And Reg D has 504 and 506 are its operative provisions saying, here's what the rules are. Most people these days are using 506. 504 allows offerings, I think, up to 10 million in a variety of ways. But that variety of ways are no better. The best one, the most permissive thing, is a 506 offering only to accredited investors. 506 by itself, if one is offering to non-accredited, includes some requirements on disclosure. Those disclosure requirements require that a private placement memo be delivered containing certain specified things. It puts a limit on the number of non-accrediteds that can be offered to, 35. And there's a bunch of state filings that one does. One of the nice things is that those state filings are notice filings. There's basically one sends some money and a notice to the states involved and doesn't have to jump through the state hoops. This preempts those state hoops. Well, what is an accredited investor? Because an accredited investor will exempt you from almost all of those requirements. Odd Matilde, you've looked into accredited investor. Would you mind explaining a little bit? People may have run into this before, but let's go through.
That's right. So as Oliver just mentioned, accredited investors are very important. And why? Because contrary to what Oliver just said, having accredited investors allows company to raise money without going through the full SEC registration. So it reduces disclosure requirements, the limits on the investors, and just overall the transaction complexity. So how can individuals qualify as accredited? So there are two primary ways to qualify. There is first the income test. So the investor must have an individual annual income of $200,000 or more, or if it's with a spouse or a partner, the income must be over $300,000. So this requirement must have been met for the past 2 years, and the investors must reasonably expect to maintain it. So that's the first one, the income test, and then we have the asset test. So it's for all individual investors who have a net worth exceeding $1 million. And this $1 million must exclude the value of the primary residence. So the house does not count towards the threshold. And once again, the asset test is calculated individually or jointly with a spouse or a partner. Now, how can entities qualify as accredited? So the common qualifying categories include entities that have over $5 million in assets, and entities where all equity owners are accredited investors. So there are other categories and other institutional investors that are recognized, like trusts, for instance, but I won't go in detail for those ones. For the practical impact of the entity seeking an investment, so I'm going to go back to 506 just for a second. So there was Rule 506B, which states that issuers can include a limited number of non-accredited investors when they do have accredited investors, so it's limited to 35. However, those entities cannot solicit or advertise to market their securities, and having non-accredited investors as well triggers the disclosure requirements for them. And then we have Rule 506C, where the entity can broadly solicit, but all investors in those entities must be accredited, and the issuer must take reasonable steps to verify that those investors are accredited.
Thank you, Matilde. That's very good. So essentially, moderately wealthy humans and mediumly asseted companies. So companies with 5 million in assets doesn't mean net worth. It says assets rather than net worth. So they can actually be bankrupt provided they've got 5 million in actual assets. There are other criteria. One important other criteria is that the directors and officers of the issuer are also accredited, so they can participate even if they don't meet the other things because they're insiders as well. So this accredited thing, as Odd Matilde said, particularly in 506. Now 506 is interesting because 506 basically says if you're not dealing with accrediteds, go back and look at the requirements for disclosure, etc., which are not going to be as bad as a public offering, but are still moderately onerous. A big private placement memo. Here's a list of several pages of what needs to go into it. Okay. But if they're just accredited, we don't have a minimum documentation requirement. We're looking a little bit back at like we're at 4A2 again, where there's no minimum documentation requirement. Again, no lying, cheating, and stealing. Make sure that the deck is appropriate. All it's not without its rules, but there's nothing specified. So people tend to. This drives the market in investors in companies to just the accredited folk. It's an interesting byproduct of all this is that essentially folks who are not moderately wealthy have been basically cut out of early stage investing as a result of all this. That's an interesting piece of that. Although if one is back in 4A2, Aunt Matilda can still come in even if she's not accredited under 4A2 if we feel satisfied with that and we meet the blue sky requirements, etc. There are ways to deal with that. But even so, the 506 accrediteds is the big route that most places go. Hedge funds raising $1 billion, 506 to accrediteds because there's no monetary limit, and if you're only dealing with accrediteds, there's no number limit you can sell to as well. There are some restrictions on how you market it. You can't market it to the public, but again, if you're doing a big hedge fund to private investors, maybe you don't going to the public anyway. So again, it is a very, very heavily used piece. So Reg D under that to accredited investors. Whew. Questions on any of that? Again, this is a point where we're getting some good outside counsel is almost always a good idea. By the way, going into any of these fundraising thing, one should either have an outside counsel who's willing to do it on a sort of subsidized basis. Outside counsel will sometimes. I work with an outside counsel who will comp my new company if I should go this route up to $40,000. But that comping will be recovered in the first significant raise. So basically, they are acting as though they're lending me this subject to actually effectively getting the money back. All right, it's better than me being out of pocket. They're taking some risk with me, which is nice. I don't have to throw that 40 grand to them early on, but it will come out of the company's raise when the time comes. So again, that kind of thing, good attorneys early on in this is pretty critical.
Oliver, the folks who do that kind of work are kind of a special animal within the ranks of attorneys nationwide. And my understanding is that many of those attorneys who would be willing to take equity in exchange for fees, at least partially, are mostly not in Vermont. But that's not really a barrier, right? Because
That need not be. Again, there are firms that there's probably I don't know 20 firms, 30 firms nationally that do this kind of work. They will have different approaches to that kind of early stage helping you out. Again, and part of it is who you're talking to there and what their deal is internally. And I mean, it's quite variable in how much and what they were able to do. Also, how much are they in demand and how much they're looking within Vermont itself. There are firms that are capable of this. There are firms, both some of the larger firms and even a few of the smaller specialty firms, which are very capable of this. The deals that they're willing to cut, I'm aware that some of them will at least cut some deals. How much of a deal is a question, and what the terms of it. It's a little bit like saying, hey, back in the old days when the farmer would bring some chickens, is that okay? What can we bring to you instead? Because we don't have that upfront money. Again, I don't know what, but Kat, do you have any perspective on any of that? What you're seeing?
No, honestly, not so much. Sorry, I can't tell if you guys can hear me with that up or down. Yeah, and as far as beyond Vermont, I myself have not personally. I've been writing down so many notes because I'm very excited to go back to my advisors and gather more information about what they've been seeing. That way I can kind of give you guys those notes from the SBDC side. I'm sorry, I don't have too much to add there, but I'm learning a lot here myself. So this is very, very helpful. But yeah, I'm going to ping my crew and see if they have any insight that I could provide for future webinars as well.
And to go back on that again, if whether it's local or from away, exploit some contact, come in, and explain. They'll base their approach partly on whether they think that you're actually going to have a good. They're becoming investors with you in a sense, and are you a good bet or aren't you a good bet? And if they think you're a good bet, they may cut you some slack, whether it's local firms or national firms on this. They're the famous national firms. One of the most famous on this is a place called Wilson Sonsini, which is based in Palo Alto, and they were the early lawyers for a bunch of companies such as Google and things like that. And their senior partners have retired wealthy because they said, okay, we'll give you a deal, but you're going to give us a little bit of the company. And a little bit of some of the better companies turns out to be really quite good money. So there we go. There's a famous rug store in Palo Alto that had an upstairs loft that they would rent to startup companies, and the rug store owners have retired wealthy because of the early stage stock deals they took in return for the use of the upstairs loft space for the early stage companies. So anyway, these deals are out there. They're harder. They're not always easy to find, but they're also more out there than one. Very few startup companies actually end up paying sort of a full price for the early stage services is my impression. That comes from representing people in these areas too. Okay, yeah, we'll cap it out at the hours, the normal hourly charge and setting up and all that might be $10,000. We'll cap it at $5 and call it a day, and hopefully you come back to us with the next round of work. I will tell you that in my company we used some folks who gave us early free services. They stopped being free after a while, and in the acquisition, the amount that we paid them, the bill was in the low nine figures. So don't cry for me, Argentina, as the song says.
Presumably that equates to a fairly high per hour billable rate for the folks who did the work early on.
Yeah, it worked out. It worked out well for them. They did all right.
Yeah.
Right, other questions on that?
Yeah.
Online portals. I mentioned there are online portals. They are possible. The access to the online portal goes through a portal running company. There are these companies that run the portals. They do the deal essentially with the incoming company that wants to offer things on the portals. The portals have their own rules about disclosure and their own rules about who can invest. Essentially, anybody can invest, but they can only invest in up to certain percentages of their income and their worth and things. So this is a democratizing step. There are people who use this successfully. I have not done a company that did it, but it is there as a possibility. If this interests any of you, it's worth seeing. Again, there are caps on how much can be raised. The cap is enough to get you started, but it's not enough to be wildly interesting money. I recognize that sounds. I don't mean to sound blasé about $1 million. $1 million is whoa. There's a time when that's what you need. But again, as companies grow rapidly, the needs can get bigger as well. Reg A isn't quite an exemption. It's like a mini public offering. It costs about half as much probably in the end. There are limits on that up to 100 and 120 million and things like that. So Reg A is out there. I just will mention it because otherwise my slide would be incomplete. People who are interested in Reg A, I'm happy to talk. But again, that's typically a fairly developed company would go out through Reg A for like a second or third or fourth round probably to go do a Reg A round. Okay. Questions? Next slide. Tax. Woohoo! We're getting there.
This is our last substantive slide.
Brian, you want me to do the VC thing? You want to do other? How do you want to do it?
I can get us started here. Sure.
Okay, take it away.
So we talked a little bit about VCs preferring C corporations, particularly Delaware C corporations. And there are various reasons for this. One of them is just a legacy, essentially, because Delaware C corporations were originally fairly business friendly. So VCs built up their systems around the Delaware C Corp ecosystem and are now stuck with that ecosystem because of momentum. But there are other reasons too, and one of them is particularly related to tax. So um, Oliver will have much more to say about the details of this. But um, well, actually, Oliver, why don't you get into, before I move
Okay.
on to sort of the other benefits and the small business, the qualified small business stock and so forth.
The the
Yeah.
um the uh one of the reasons that the VCs do this is that frequently investors in the venture capital funds are either um, um, uh, nonprofits, or they are nonprofit endowments, in particular big university endowments and other big endowments, or they are foreign people, non-U.S. citizens or residents. And those participants, because the form of the venture capital fund is typically some kind of partnership or LLC with a pass-through taxation, anything the VC fund invests in will pass through to those investors. And if it's in a LLC form, particularly LLC taxed as a partnership, now those are now vicariously in the business that the company invested in is in. So if I've got an LLC that's running a bicycle manufacturing company in the U.S., if it's done this, if it's an LLC taxed as a pass through, then all of the investors in the VC's fund are now in the bicycle business in the United States. And nonprofits are not allowed to be in the bicycle business in the United States, typically, because that would be an active business that would not be part of their exemption. And foreigners might not want to get sucked into being U.S. taxpayers directly. So there are certain reasons why the investor pool for VCs also prefers C corps, which really have to do with the nature of the taxation of the investor pool which they are setting up. They would prefer a C corp. Also, they're not looking to have the deductions and have all the things that a pass-through entity could supply. They're looking to have capital gain at the end. And many of the companies that are involved are not going to have taxable income early on. They're going to have, run at a loss. Now, it might be nice to pass those losses out through, which is something that can be done if that's an investment through a pass-through entity like an LLC. But the VC style investing really is looking for that capital gain bump at the end rather than anything in between. And so they're perfectly happy to not have tax consequences, have that tax veil between them and the corporation, provided it doesn't then get their investors in trouble, and they can get that capital gain at the end. So they tend very much to prefer C corps, basically. And as Brian said, the Delaware one, the documentation is all set up for Delaware. That's what they want. Other benefits. There's other things that flow from tax standpoint. Brian, what do you want to pick up on this?
Yeah, so this first one, QSBS, is qualified small business stock. So this is a typical type of stock that would be issued by a U.S. C corporation. And the key thing here, I think, is that there's the potential to exclude all of the capital gains from tax. So this can be a very, very big deal for VCs or any other investor because, of course, the capital gains is precisely what they are after. And the idea that subject to certain restrictions, and Oliver probably knows all or most of those restrictions, they can end up with no tax bill whatsoever on the gains that they make on that investment. One of those is that they hold it for a certain amount of time. I think it's 5 years.
Typically 5 years is the
Yep.
typical holding period.
Yeah.
And then it has to be in certain kinds of businesses, financial businesses, not so much, tech businesses. Frequently, there's a whole set of different tests that get applied to this. But if Brian says, if it meets it, 20% tax just came off the top as the long-term capital gain rate. Gone. And states, not all states recognize it. Vermont is one of the states that does. Another 9% comes off the top there. So the end savings can be significant. I'm the personal beneficiary of some of those savings, so I'm happy to be able to announce. So it is a very interesting piece of this. Again, not all small companies will qualify. And there is that time frame, et cetera, but it sits out there as a significant potential tax advantage. Now, you may ask, well, why does that exist? Well, because it would be shame to tax wealthy people on additional wealth that they get. But the actual justification is, it will help stimulate investment in these tech and other category businesses that we want to see investing in, putting a carrot out there, for folks who've taken the high risk with an investment and waited on it for 5 years. Hey, we'll give them this benefit up to 10 mil. Right now, I think that's been increased up to 15 or 20. So it's just there was just an increase in the last year on that. Option plans.
Yeah, so we've been talking about stock. This is one of the things that distinguishes C corporations from other kinds of business entities like LLCs, is that they can issue stock, and we've been talking about all these various forms, common stock and preferred stock. So this becomes a sort of currency that the corporation can use in its dealings with others, as we've also been talking about, right? This is one way to maybe get legal help, or maybe get some other kind of help, or to attract investors. And one of the things that can be done here is stock options plans. To Oliver's point earlier, that's typically done with employees, where employees are being offered stock options as part of their compensation package. And there are tax benefits and implications associated with that. And Oliver, you want to talk more about the details of how that is structured?
Yes. A qualified plan, first off, typically means that we issue the options at a strike price. That's the price that you can buy the options for. And that strike price it's advantageous to keep low. Because obviously that's useful. If it's a bargain, if it's lower than fair market value, then the value of that difference in value is current income. So if my stock was worth $10 a share and I gave my employees the right to buy it at $5, they would be getting an immediate benefit of that $5 difference, and that could be taxable income to them this year in the year of the grant. In order to not have that happen, basically a qualified option is set up in a certain way, and the stock will be issued at a then applicable outside appraisal value. And that's one of the things Carter will do. Other folks will do it for you. They're allowed to take various discounts on so it doesn't have to be the most recent issued price. They can a bunch of discounts they take. It's a little bit of an art as well as a science as to what that valuation could be. But once it's in place, then we issue our shares at that. And now, if things go up, that means that they can buy shares. So if we issued the shares at $10, if the company sells at $100 a share, they can buy the $10 shares at $10 and now cash out on the difference. The trick on that is that cashing out is probably not capital gain and isn't QSBS because QSBS means you have to have actually owned the stock for 5 years, and long-term capital gain means you have to have earned the stock. So that you may get the benefit of the bargain price and not having been taxed on that bargain price early on, but you're also getting taxed fairly rigorously on the difference as you go forward. Another piece of this, which I should mention, and it's not on the slides, is what I believe is 43B, which is this: if one issues stock to employees subject to divestment, that issuance there's a tax filing that has to be done right away, or the tax advantages will disappear. There'll be tax eventually on the full price when the vesting goes away. Then the then value rather than the now value, and you want them to be taxed on the now value, not the then value. So there's a filing and the filing has to occur within a very short time, a month or a month and a half. So it is critical to make sure that filing goes forward if that other stage is used. Another reason for C corps is that tax is not an actual challenge in many early stage companies. Many early stage companies just aren't going to be making any money, so the whole double taxation thing that is a concern and why one might have pass through taxation typically isn't there. By the way, I also not mentioned here is could they be subchapter S corporations? And the answer to that is that not if they have complicated stock plans or more than 100 owners or more than one class of stock or folks who are not U.S. Human being citizens. And again, any VC deal is going to destroy that immediately. The sub S is not typically in this. Conversion. One can convert an LLC to a corporation if one has already got an LLC in place. It's doable. It's a little awkward. There's the steps for the actual conversion. Then there's a whole bunch of tax considerations about when does the basis carry over? Is it, what is the basis if one then is granting stock in the new company? Is that at what value, and is that income now or whatever? Anyway, there's a bunch of complications in that. It is possible. My own approach is to set, if I think my company is going to be into this sort of national money game, then I'm going to set it up as a C Corp to begin with and not fuss around. Questions on any of this?
I have a question for you.
Yes.
Is there an advantage for these investors to have you be a benefit corp?
Benefit corp, and the answer is little other than it may be something that's important to them from their own goals about investing.
Okay.
Benefit corps the benefit corp is a corporation set up in Vermont under the benefit corp law. There's similar laws around the country of various kinds. Delaware, I believe, has something along this line. They are companies that agree to take certain steps to have a social benefit. Typically, those steps are procedural rather than guaranteeing anything, but they will have a benefit director and they will have a benefit report, and they'll do stuff annually, and they'll say, hey, how are we doing on this goal? These are our additional goals. It will also enable them to escape from the classic statement, which is only partially true, that a company needs to be set up to make money rather than to do socially good things. That's not fully true even in Delaware, but it helps them escape from that concern. So again, if this appeals to people and is an important part of the mission of the company, it can be fabulous. But the corporate law side is largely independent from this. In other words, the issuance of stock is typically by the normal rules. The sale of stock and the board and all that is typically by the normal rules, other than whatever is laid on because of this a social benefit message. So, an investor, is there a benefit? If there's a benefit if this is what they want to invest in, but there's not typically a monetary benefit from one way or another.
Okay.
Does that answer your question adequately?
Thank you.
Okay. By the way, you should be aware that a benefit corp is not the same as a certified B Corp. There is the B Corp folks out there, and B Corp is a certification organization that will come in and say your company meets our standards for being a socially beneficial entity. So B Corp certification is done through the B Corp people. The B Corp people. They like it to be a benefit corporation. That they like it because that's the sort of starting point for B Corp certification now. But B Corp certification is a private thing. Benefit corporation is an official legal status.
Can an LLC get certified as a B Corp?
May well be. I'd have to check that. I don't see any reason why not. If it met the requirements, but again, B Corp, the B Corp website will lay those out.
Thanks.
I'll say another note about the conversion piece too. We talked about how, is it possible to turn an LLC into a corporation? Yes, it's possible. Sometimes a bit awkward, per Oliver's point. Sometimes, especially if it's very early on, it becomes possible to simply dissolve the old business and create a new one, which can be simpler in some instances. So, it's case by case, but for businesses where it's, well, I started an LLC 2 years ago and it hasn't really done much, but now I think it's going to start doing more. And I think I'm going to seek, outside investment within the next year. Okay, maybe we just dissolve an LLC and create a new C corporation. Sometimes that makes sense.
The trick there is to make sure the new corporation gets any intellectual property or other asset that would be important, and B, make sure in that transfer that there's no third parties with rights. There's no members of the LLC who aren't becoming members of the corporation and don't sign off on the whole deal. So
exactly. Once the business is getting more mature and starts having more dealings with others and maybe having more profit or more things happening, widgets being shipped and so forth, then conversion becomes the more logical choice. But if it was sort of still in the mostly ideation phase, then sometimes a formal conversion won't be necessary.
No, good, very good point. Yeah, wrap up the old and go, start fresh. And by the way, sometimes a merger is possible as well. It doesn't have to be a direct conversion. It can be done through a merger, setting up the new corporation, merging the LLC in, and having the new corporation be the successor, which can sometimes accomplish the same stuff. I think, is that our list?
That is our list. And so do have some time to take a few extra questions, although, of course, we've been chatting throughout, which we love to do. So on this slide is a short form you can fill out. You can copy this QR code to find your way to the Vermont Small Business Law Center. And we can do one-on-one consultations with folks. As we were saying at the outset, and some folks I think maybe were here and others were not, we did have a referral program where we could offer free legal help. That program is currently paused, but we hope that it will restart soon in the coming weeks to months. So you can check in with us to see if that is back online.
Right. Is there anything still out there for the on the VC funding piece, Kat? There was something that helped fund deals with that level.
SSBCI stuff. Yeah.
That's used up now.
Correct. It has been used up. Yeah, unfortunately. So, just to add on to that, we were chatting earlier, and I know that the Law Center still has the intake form for educational consults, which is, of course, extremely helpful, in addition to these educational webinars that they host, which we're very grateful for. But through SSBCI, we also do assist with additional accounting and a deeper dive into financials. And so I shared some information in the chat as well for VtSBDC and SSBCI, a lot of acronyms, I know. But yeah, feel free to reach out. Of course, you have Brian, Oliver, and yeah, I'm checking the educational events site on the Law Center's website daily, weekly. It's always great to see new events pop up, and I highly recommend you can join them when you can. Obviously, it's very informational. Thank you guys so much.
And any final questions from our participants? Wheelbarrows full of information, I'm afraid we've dumped on your heads, but
yes. And there's another QR here that I'll just point out. This takes you straight to our intake form if you want to schedule an educational consult with us. We can do a one-on-one for 45 minutes to talk about whatever particular thing is going on for you. We're a bit of lead time on those, but we're still doing those and expect to continue doing them for the foreseeable future. And you aren't limited to one either. So, as is the case today, it's an educational thing. We can't give legal advice, but we can certainly, sort of get you up to speed on what the moving parts are within the law and how the system works for whatever sorts of things you're interested in. Okay, well, if there are any other questions, we've got a few minutes. Otherwise, I'll stop the recording, and I appreciate everybody coming out. I really like that we had an active and engaged group today. It's always the most fun, and I think everybody gets more out of it that way. So thank you.
Thank you. It was great.
Thank you.
great. Good luck with it.